Welcome to today's Explainer. If you've been watching the markets lately and feeling a serious sense of whiplash, you are absolutely not alone. We are currently navigating this wild, fascinating landscape of contradictory headlines and just wildly mixed data points. So today, we're going to untangle these conflicting macro signals, cut right through the noise, and lay out exactly what the data is actually telling us.
Okay, let's dive right into this. We are looking at the ultimate macro paradox right now, and it is literally freezing institutional capital in its tracks. On one hand, we have June PCE inflation cooling down nicely to 3.6% year over year. By all traditional economic logic, cooling inflation should mean a dovish stance, right? But then, on the flip side, the market's priced-in probability of an imminent rate hike has actually spiked up to 38%. Dropping inflation is inexplicably clashing with rising interest rate hike odds. It's a massive contradiction, and it's the exact engine driving all of today's market confusion.
To make sense of all this, here's our roadmap for today. We'll start with the Great Market Divergence, move into AI's brutal reality check, look at corporate pivots and casualties, examine global threats and choke points, and finally, prep for the week ahead. Section 1, the Great Market Divergence, untangling those conflicting signals. What is truly fascinating here is the sheer scale of the capital reallocation we're witnessing. We aren't just seeing a broad market move, we're seeing a stark, violent rotation. Because of those conflicting signals we just talked about, capital is rotating aggressively out of mega-cap AI trades. This is exactly what's dragging the tech-heavy NASDAQ down into negative territory. But hey, that money has to go somewhere, right? It's flowing directly into traditional blue chips, pushing the Dow up by 0.5% to a staggering 52,210. And when you look at the sector divergence, it gets even clearer. Consumer staples are up 1.6%, while energy is down 2%. Investors are basically seeking safety and defensive positioning, and totally abandoning high-growth tech momentum. You can see exactly how this uncertainty is playing out on the ground level, too. We're looking at a profound behavioral shift in the retail market. Total retail turnover, meaning buying and selling combined, is sitting at the 98th percentile. So the retail trader is hyperactive right now. But here's the catch. Daily net buying of single stocks is at its absolute lowest level since 2020. They're trading aggressively in this choppy two-way pattern, but directional buying has totally collapsed. Retail investors are no longer just blindly buying the dip. They're heavily engaged, but completely uncertain about which direction the market is actually heading. So, the million-dollar question is, what's causing this paralysis? Well, it stems directly from macro policy, specifically Chairman Kevin Warsh's refusal to provide forward guidance. We are in what everyone is calling a silent era. Historically, when you have high predictability and forward guidance, market pricing aligns into a nice, tight curve. Everyone's on the same page. But with zero forward guidance, that predictability curve completely flattens out. This lack of communication has severely widened the variance in market pricing. The market simply doesn't know how to price risk right now, and it's scrambling. To underscore just how dangerous this silent era is, listen to this stark warning from Krishna Guha over at Evercore. He states, hiking immediately after a better June inflation print with no preparation would invite severe rate overshooting. That really highlights the immense risk the Fed is running by staying so quiet. A surprise move right now could absolutely shock the system. Let's move to Section 2, AI's brutal reality check. The semiconductor sector is suffering some severe drawdowns. Negative 11%. Just let that number sink in for a second. That is the overnight crash of the South Korean Kospi Index. It marks the absolute worst monthly performance for the index since the 1997 Asian financial crisis. And the epicenter of this massive earthquake? You guessed it, the semiconductor sector. Let's see how this contagion is spreading across the global supply chain. The Kospi crash was the trigger, but it's pulling down the entire memory and storage space with it. We're seeing major players suffer due to extreme hardware valuation exhaustion. SanDisk dropped 11% in a single day, cementing a brutal 44% drawdown for the month. Micron down 22% for the month. And over on the equipment side, ASML and AMD are both citing over 5%. The market is suddenly looking around and demanding structural proof that these massive valuations can actually hold up. And right now, that momentum is aggressively breaking. Which brings us to the elephant in the room and honestly, perhaps the most important question in this entire sector right now. NVIDIA's shares recently dropped 5% following reports of a $250 billion backstop provided by the hardware maker itself to finance data center bills. The cycle basically works like this. NVIDIA provides financing, that capital builds an OpenAI data center, and that hyperscaler then uses the capital to purchase more NVIDIA GPUs.
The fear gripping Wall Street is this. Is hyperscaler revenue growth genuinely organic and driven by end-user demand, or is it being synthetically propped up by circular financing from the hardware makers themselves? But hey, before full-blown panic sets in, let's zoom out and look at some historical context. The current bear case is the worry that AI hyperscalers just can't boost revenue faster than their immense running costs. But let's remember the Cisco model from 1994 to 2000. Cisco is the ultimate hardware provider of the dot-com build-out, and they experienced multiple, terrifying 40% mid-cycle drops. I mean, one drop took them from $18 all the way back down to $9. Yet, the ultimate move was 80 to 100 times higher, eventually reaching $80. Many analysts argue that we are simply in the mid-cycle correction phase of the AI build-out right now, literally identical to Cisco in 1997. In chaotic tech drawdowns like this, it is always wise to remember these words from the late Charlie Munger. The big money is not in the buying and selling, but in the waiting. Strategic patience is often your absolute greatest asset during severe mid-cycle volatility. Of course, there are also new structural threats to consider. China's CXMT recently launched its IPO and surged an incredible 466%, hitting a $484 billion valuation. They are now a massive structural threat to the memory oligopoly currently held by Micron, SK Hynix, and Samsung. Geopolitically, this is incredibly complex. The source notes that Apple is actually actively lobbying the Trump administration to keep CXMT off trade blacklists, specifically so they can secure components for their Chinese market devices. It's a striking reminder of just how deeply intertwined technology valuations are with global trade policy. Section 3. Corporate pivots and casualties. Shifting strategies in a volatile market. Let's consider the illusion of growth, perfectly illustrated by Starbucks. If you only looked at the top line, things seem great. Global comp store sales are up 6.2%. But the bottom line reality? It's a bloodbath. Fiscal year EPS expectations have dropped by over 50%, and trailing 12-month operating margins are down by a third. Why? A massive drag in China. 19% of their global cafes are in China, and they're now being forced to sell a majority stake in those operations. A unit that was once predicted to overtake the U.S. is now valued at less than $14 billion. The stock is painfully repricing from this hypergrowth story into a mature, highly constrained reality. Meanwhile, other corporate giants are completely jumping ship to new sectors. With a stagnant traditional consumer auto market, Ford and GM are pivoting their heavy manufacturing capabilities directly into the defense sector. They are aggressively bidding to build the Army's new tactical truck, the Infantry Squad Vehicle, which is a contract for over 10,000 units. The benchmark they're looking at here is General Dynamics Combat Systems, which generates over $1 billion in operating profit on $10 billion in revenue. By pivoting to these high-margin government defense contracts, Ford estimates this could boost their operating profit by $500 million by the end of the decade. Talk about a massive pivot. And then there's MicroStrategy, pulling a massive defensive maneuver. They've completely halted their reliance on stretch preferred stock because of dividend coverage concerns. Instead, they just sold 5 million shares of common stock for roughly $544 million. Why? Well, to repurchase preferred stock and stabilize its price near $100. And the ultimate goal of this common equity pivot? It's to build a fortress around their core asset base, an untouched $55 billion Bitcoin stockpile. It's a totally fascinating look at capital deployment designed purely for treasury defense. Moving on to Section 4, Global Threats and Choke Points, Physical Constraints Driving Inflation. These physical choke points are exactly why inflation might prove so much harder to kill than the Fed hopes. We have two massive physical supply chain choke points squeezing the globe at the exact same time. In the West, it's climate risk. There's an 81% probability of an El Niño system causing severe drought in the Panama Canal, which would cut daily vessel transits from 36 down to 18. That's a route that handles 12% of U.S. goods, and it could get sliced in half. Then in the East, we have geopolitical risk. Despite a U.S. and Iran pause, ships are still avoiding the Red Sea's Bab al-Mandeb Strait. Rerouting all the way around Africa is outing weeks of transit time and millions in fuel costs per single trip. These physical constraints are a very real direct threat to reignite consumer inflation. Finally, Section 5, the week ahead. Let's look at the catalysts and the calendar. This week is an absolute gauntlet. Nearly one-third of the entire S&P 500 reports results, including 4 of the Magnificent Seven. Tuesday gives us consumer confidence and heavy industry earnings like Boeing and Ford. Thursday brings the vital Q2 GDP estimates and big tech earnings from Apple and Amazon. And Friday closes us out with traditional energy.
But make no mistake, Wednesday is the undeniable main event. We have AI bellwethers Microsoft and Meta reporting, combined with the Federal Reserve rate decision. We will finally see if Chairman Warsh breaks his silent era, and more importantly, how the market reacts if he doesn't.
So I want to leave you with this final thought based on all the data we've explored today. As capital aggressively rotates from tech over to defensive staples, and as global choke points physically tighten the world's supply chain, you really have to ask yourself, are you positioned for a temporary Cisco-style mid-cycle AI correction, or are we witnessing the beginning of a much broader structural market shift? Thank you so much for joining me on this explainer. Keep an eagle eye on that Fed decision this Wednesday, stay focused, and keep learning.